Intel has been one of the strongest companies in tech for years. But it seems those days may be over. Today, they are facing some serious trouble. How serious? Well, they are planning to lay off over 15% of their workforce as part of the $10 billion cost reduction plan. They also decided to cancel the annual Intel Innovation event this year, which on one hand shows their commitment to cutting costs, but on the other hand could be seen as a sign of some very serious trouble. Additionally, they sold nearly 1.2 million shares of ARM Holdings for $150 million, which the company needs to stay relevant in the industry. And finally, to save as much cash as possible, they made a very significant decision that we will get to in a minute. All of this has triggered a massive wave of sell-offs, causing the stock to drop 56% since the beginning of the year. But is it really that bad? Is Intel truly going under? Or is the market overreacting? And everything we just discussed can actually make Intel much stronger in the long term. And if so, is Intel a surprising investment opportunity at the current time? Well, let's find out. If you were to invest $1,000 into this company 10 years ago, you could buy around 28 shares. And now they would be worth something close to $580. Not great. But luckily Intel also pays dividends, so in that time you would get $309 as dividends. So if we add together the current value of shares and the dividends, we get $889. And that is a loss of 11.1% in 10 years. Probably not a big surprise given the recent performance, but nevertheless not something we would like to see. Individual insiders, that is an X, only less than 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%. So the management does not have its skin in the game. And are individual insiders buying? That is a check. We see a lot of buy transactions in the last year, mainly by Patrick Gelsinger, who is the CEO of the company. And do super investors own Intel? That is a check. 4 super investors own shares of this company, including Christopher Davis and David Tepper. And are they buying right now? That is a check. Christopher Davis bought 5,850,000 shares last quarter, and David Tepper sold 970,000 shares. So it seems that Davis really believes that Intel can bounce back and that the current stock price created a great investment opportunity. Return on invested capital, that is a check at 15.4% 10-year median returns. And we want to see this number higher than 10%, so in the long term this looks nice. And what do we know about net profit margin? It is also a check averaging 19.1% over 5 years. And the industry average is 16.5%. But that does not tell the whole story, because recently net profit margin is only 1.7%. That is one of the main reasons why a lot of investors believe that Intel is not going to be back on its feet anytime soon. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 15.4% of their shares. And the debt? It is an X. It would take them 10.5 years to pay the long-term debt with a 5-year average free cash flow. And I'm using a 5-year average free cash flow because the current one is negative. So that is another red flag after falling margins. Such a debt for a company that is barely making money is a huge problem. And this debt may be one of the reasons they decided to sell their shares of ARM Holdings. They need all the cash they can get to keep it under control. Revenue growth, that is an X at 0.3% 10-year compound annual growth rate. So that is an extremely slow growth. And what do we know about free cash flow growth? That is an X at minus 238% in the last 10 years. Current free cash flow is negative, and not by a little bit. It is over $14 billion in the red. So that is not encouraging at all. But maybe earnings per share growth will look better. Well, it is also an X at minus 14.4% in the last 10 years. So yes, it's not as bad, but it is going down. I have to say, I did not expect to see such poor results when it comes to growth. So that is another red flag. Now we get to the last big decision made by the management to cut costs. Intel suspended its dividends recently, and we don't really know when or if they will go back to paying dividends. They said that it had to be done to have a chance in the fight against Nvidia, AMD, or TSMC. But that sounds a bit optimistic. It likely had to be done so Intel could pay off some of its debt and have money not only for investing in research, but also for everyday activities. This decision probably had a huge impact on investors and pushed the price down. But on the other hand, it really shows that Intel is committed to cutting costs and turning things around. They will definitely suffer in the short term, but it may be a great long-term strategy, or even the only strategy that can save the company. To value Intel, we will use a discounted cash flow valuation, and we will create 3 scenarios of its possible future growth. So, in the low scenario, we will estimate no growth for the first 5 years, and then 3%. In the medium, 5%, and then 7% growth. And in the high scenario, 12%, and then 14%. So, the low scenario is close to the current growth of the company, or rather, lack of it. Medium is predicting that Intel will grow substantially slower than the semiconductor industry, which is predicted to grow at around 14.9% in the next few years. And the high one is showing a story in which they will manage to grow with the market, which may be a bit optimistic. So, with such estimates, the intrinsic value in the low scenario is $4, in the medium $9, and in the high scenario $21. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that makes you feel comfortable. And with such a margin, we get in the low scenario $3, in the medium $6, and in the high one $15. And the current price is around $20. So even after the recent price drop, Intel does not look like a bargain. So we have a lot of red flags. Huge debt, falling margins, suspended dividends, laying off 15% of the workforce, and the list could probably be much longer. Looking at our Stock Ranking Pro, which you can get access to by becoming a Patreon, we see that their overall score is extremely poor. Intel ranks 83rd out of 93 companies in our ranking. And the overview of the company shows that financial health is sort of okay, investor sentiment is very good, but there are no dividends, which of course does not have to be a big thing if a company is growing rapidly. But in Intel's case, growth has been terrible. So they are in a very bad situation right now. If they don't drastically cut costs and do so quickly, the debt will slowly eat them alive. On the other hand, they are taking action. They are trying to turn this company around. They're not focused on short-term market reactions, but are instead looking at the long term, which is probably a very wise strategy. The real question we should ask is it too little, too late? Or will they emerge from this crisis as a healthy company ready to fight for their share of the market? Thank you so much for watching and see you in the next one.